Hi everyone, welcome back to GeoCurrent. For the last 2 years, the story around advanced chips has sounded pretty familiar. The United States builds new barriers, and China looks for ways around them. A straightforward game of pressure and pushback. But this week, the pattern broke. Washington essentially opened the gate. They authorized the sale of Nvidia's powerful H200 chips to China, with one catch, a 25% premium fee. Most analysts expected a gold rush. They expected Chinese tech giants to flood the market with orders. That didn't happen. Instead, reports from the Financial Times and Reuters suggest the opposite is taking place. Beijing is preparing to limit the purchase of these chips. They are looking at the fastest hardware on the planet and choosing to hold back. Today, we're going to break down why. We'll go beyond the headlines and look at the incentives driving Beijing's thinking, the economic risks, the strategic calculations, and the long-term consequences. The poisoned offer. To understand China's hesitation, you have to think in terms of national strategy, not just corporate profit. The US offer was specific. You can have the H200, which is a distinct upgrade over the crippled chips sold previously, but you pay a 25% premium fee. From Washington's perspective, this deal looks great. US companies get a huge new market, and the US government collects a fee on every chip. But from Beijing's point of view, this offer comes with real costs. You don't have to guess at Washington's intent. You just have to read the document they released on December 4th. The new 2025 National Security Strategy explicitly labels China as the top economic competitor and outlines a goal to stop Beijing from moving up the tech value chain. That document is evidence of how Washington sees this competition. It confirms that the 25% fee isn't just a tax, it's effectively a containment tariff. It channels money back into the US system that's designed to maintain its technological lead over China. Furthermore, the fine print of the deal is the real trap. Access to H200 is restricted to approved customers vetted by the Department of Commerce. And crucially, Washington retains broad discretion to revise or suspend permissions for any national security reason. If Washington decides the relationship is shifted, the chips can be remotely disabled. Overnight, the investment drops to zero. China understands that accepting the H200 now would undercut its domestic semiconductor industry before it fully matures. And the real issue isn't just the chip, it's the software that comes with it. Nvidia's entire advantage comes from its proprietary software system, often called the CUDA platform, which is the foundation most advanced AI tools are built on. You don't need to know the technical details, just think of it as the operating system of the AI world. Once a country builds its entire tech stack on that system, breaking away becomes incredibly difficult and incredibly expensive. It's like building your entire national railway on tracks that only one foreign supplier can manufacture. And as long as Chinese companies rely on that American software foundation, Washington quietly holds the stronger position. That kind of leverage, subtle, embedded, and hard to escape, is exactly what China is trying to avoid. The signals from Beijing. Let's pause and look at the evidence. Is this actually happening, or is it just rumors? The signals are subtle, but they are definitive. At a recent press briefing, Foreign Ministry spokesman Guo Jitan didn't praise Washington's decision, didn't call it progress. He simply said China had noticed the reports and shifted to familiar language about cooperation. That was a diplomatic way of staying non-committal. Next, look at the major Chinese companies. According to Reuters, the big players, ByteDance, Alibaba, and Tencent, are interested in the chips. Of course they are. They're businesses. They want the best tools available. But they're not placing orders, not yet. They're waiting for government guidance. They've been called in by regulators. Everything is on hold. This isn't a technical delay, it's a policy decision. There's a clear gap between what the companies want, which is speed and profit, and what the state wants, which is security and independence. And in a Chinese system, the state sets the direction. Sun Tzu's hidden strategy. This brings us to the sleeper theory in strategic competition. Appear weak when you are strong. Why would Beijing risk falling behind in the AI race? AI is the engine of future economic growth. Rejecting the H200 means slower model training. It means using more hardware. It means inefficiency. The answer may be simpler than it appears. They may believe they can catch up sooner than outsiders expect. China has a long track record of revealing major breakthroughs after they're ready, not before. We saw this with Huawei's unexpected Mate 60 5G smartphone back in 2023, running on a 7-nanometer chip that some analysts assumed China could not yet produce. There was no press release, it just appeared. And if you look at the markets today, the Chinese public seems to have taken note. Just look at what happened on December 5th. More Threads, often called China's Nvidia, went public in Shanghai. It debuted on the Shanghai Exchange. Despite its earlier restrictions under U.S. export controls, the stock soared over 400% on opening day. On the same day, Meta X, another domestic GPU maker, saw its IPO oversubscribed by nearly 3,000 times, a remarkable demand signal. That's not how a panicked market behaves. That's how a market reacts when it thinks a breakthrough is coming. The firm rejection of the H200 suggests internal confidence. It raises the possibility that domestic solutions, likely centered around Huawei's Ascend series, are further along than Western analysts currently model. They may not have a single chip that beats Nvidia, but they could have solved the packaging problem. They may have figured out how to string thousands of smaller processors together to create a supercluster that rivals a US system. In other words, China may be betting on long-term independence over short-term speed. A slightly slower tool you fully control is often more valuable than a faster tool someone else can take away. The fallout, the splinter net. So what does all this mean for the rest of the world? If Beijing continues down this path, we may be witnessing the start of a major split in global technology, hardware splinter net, between two competing systems. Block A is the Western bloc, built around Nvidia chips and American software, fast, proven, and high-end, but also tied to political relationships. You can only use it if Washington signs off on the paperwork. Block B is the non-aligned bloc, built on Chinese hardware and Chinese platforms, not as fast today, but cheaper, widely available, and offered without political strings attached. Think about the global South. Think about nations in Africa, Southeast Asia, or Latin America. If you're a developing nation building your own AI infrastructure, do you buy the expensive American kit that comes with a list of political conditions? Or do you buy the Chinese sovereignty kit, an entire stack of hardware and software that is yours to keep, regardless of your foreign policy choices? This is where things get interesting. For the United States, this is a double-edged sword. In the short term, American firms may profit from limited sales. But in the long term, if China closes its market and becomes fully self-reliant, US companies lose their biggest customer and the revenue that funds future innovation. If that money disappears, the innovation gap between the US and China could start to close. For China, the short term is going to be painful. Their AI models will be slower for a while, their tech firms will bleed cash. But if they make it through this period, they end up with a system no one can choke off. That's the endgame. Conclusion: the US expected the H200 decision to give it leverage, a way for Washington to maintain influence over China's tech trajectory while making a profit. Instead, we're watching Beijing step back and take a harder, more independent path. It's the more expensive road, it's the slower road, but it's the road they fully control. This is no longer a story about chip performance, it's about who sets the terms of the future digital economy. Now I want to hear your thoughts. Do you think Chinese domestic technology is actually ready to stand on its own? Or is this a high-stakes gamble that could slow their progress for years? Let me know in the comments. I'm the analyst for GeoCurrent. Thanks for watching.